Joining us for the next hour, David Bloom, Global Head of Foreign Exchange Strategy at HSBC. David, good to see you.
Yeah,
Also with us, Marc-Faber, Editor and Publisher of the Gloom, Boom and Doom Report, joining us out of Zurich in Switzerland. Mark, welcome to you. Mark, the very fact...
Thank you very much.
The very fact we've got this report here that the Fed might consider rolling over their purchases, how are investors to read that?
Well, investors should have listened to me already 6 months ago when I wrote that the Fed would continue to monetize, and this is my view. They will never let up. They will print and print and print until the final crisis wipes out the entire system.
Is that because they're more concerned about deflation than anything else?
They are very bad forecasters of economic events. In particular, that was the case for Mr. Greenspan, but Mr. Bernanke is in the same boat. He has no clue what the economy is doing. And so they misread in 2007 the severity of the forthcoming crisis, and then they misread in the last few months the strength of the economy, which is, unlike your commentator before just said, shows no sign of strengthening, but signs of weakening everywhere in the world. And therefore, I would argue that the Federal Reserve, with its policy and with the writings and papers Mr. Bernanke has published about the Great Depression, that more quantitative easing will be forthcoming. And significantly more.
All right.
Significantly more.
This is why we like having you, Mark, because you don't pull your punches. We'll come back to that. I just want to get... David's been listening to that. Well, strong stuff.
Yeah, it's a bit extreme from my view. I can understand where it comes from. I think it's a little bit extreme. I think we're not quite at those draconian points. But the biggest problem we have in the FX market is, okay, that's happening in the US. What do you buy? Okay, we don't like the dollar. Let's decide we don't like the dollar. Okay, so what we're buying? And then you're stuck because you're not that comfortable with the euro. Sterling's doing fantastically well at the moment, but you're not that comfortable with it. So the problem is, where isn't it happening? And it takes you to, say, maybe some emerging markets. But then if you face a financial crisis rather than an economic one, we've seen massive contagion. So I think that the problem now is you know what you don't want, but you're struggling to find what you do want.
Well, do you want, David, gold? Because it seems like if the Fed steps in... okay, well, let's talk about it. If the Fed steps on the gas, going on with your analogy, it could be bad for the dollar and good for gold. So if they don't step on the gas, then you could also get the inflationary trend. So it seems like gold gets it from both ways, the fear trade or the inflationary trade.
Yeah, I think there's no doubt in my mind that the Fed is going to step on the accelerator. That's how they believe in the US. We've seen in the Eurozone, as soon as Germany and France have picked up, they've tried their best to give haircuts now that are bigger. They're trying to roll back QE. On Japan, you've got a slowing economy, and they're refusing to do QE. So we've got a world that's like broken into 4 pieces. We've got the US that's slowing, they want to do QE. Japan that's slowing, no QE. Europe that's picking up a little bit, rolling back QE. And UK, which we've got someone voting for a rate rise. So it just seems all over the place at the moment. There's no consistency to really what's going on. And I think there's absolutely no doubt the US will always believe it can grow itself out of this situation. And I think that's Mark's point, that they won't hold back, they'll just keep going.
Hey Mark, this is Christine, all the way from Singapore, asking you a question. We have a report today from PBOC in China saying they're asking big gold companies to actually issue bonds. Is this a sign that the central bank there is trying or working hard to diversify away from US Treasuries?
Well, I think that everybody in the world has some concerns about the ultimate value of the US dollar and also obviously about the value of US government bonds, because if the fiscal deficits stay at this level, and in my opinion they are likely to actually increase over time, then obviously you will have a credit problem in the United States sooner or later. It's not going to happen in the next 3 years, but thereafter. So I think that the diversification out of US dollar treasuries is desirable. And that's why I'm not all that negative about equities. I think that if you look at the different investment alternatives, equities, bonds, real estate, commodities and precious metals, I think that equities should be represented in a portfolio, even in particular, if you're very bearish about the world long term, you probably be better off in equities than in bonds.
David, that's an interesting point, because we're at a point at the moment where we talked about this, where the risk is you're either buying risk, and that's equities, or you're not, and you're buying government debt. So if Mark's right, how's that going to break down?
I don't really agree that you can hold equities as part of a portfolio, and the reason is asset markets have become massively correlated. What you really want to see in markets is, room for relative value, asset allocation, different asset classes. But what we're seeing at the moment is bright red in terms of the markets are just highly correlated with each other. There's no room really for relative value.
Now we've got something, actually, I don't know whether we can do it now, we've got time to do it, but you've got something to show us where you suggest how correlated markets have been compared to where we were.
If you just showed a matrix of 50 different asset classes, you would just see a whole lot of numbers. We've got 3 very brilliant PhD math students who worked on this, and it shows here you can see the chart with the yellows, and now you move forward in time and you get the crisis in these deep red areas, pockets of red, and now we're going to hit the Lehman's crisis as we go forward. Now, bang, and markets become highly correlated with each other. Then they try and pull back a bit, and then we move into Dubai now, and then we move into the Greek crisis, and this heat map is red and dark blue, saying markets are highly correlated. All you've got is either a choice of bonds, risk, or anti-risk. It doesn't matter if you're in equities, credit, or anything else. You're either in the bond market or you're in the equity risk world. There's no choice elsewhere.
Okay, we'll pick up on that point. Good to have both David and Mark.